Yeah. Good afternoon, all of you. Good afternoon, Savitri Parikh Madam, and good afternoon, Amita Desai Madam. I welcome you on behalf of ICSI, and my heartfelt welcome to all the participants who have joined this webinar on RPT, related party transactions, and its scope and necessity for RPT audit. Friends, CRA's level of amendments in LODR to be effective from 1st April 22 and related party transaction is such a critical topic that everywhere it's a communication gap between LODR, between Companies Act, between rules, between MSUP form everywhere. And friends, under the guidance of our President Devendra Deshpande ji and Vice President Manish Gupta ji, we are coming with a series of webinar like this, like RPT scope and necessity of RPT audit today. Then in coming days, corporate governance and its scope and necessity of audit. Then in coming days, other audit also. Friends, our the views of our president is this, that why we depend always upon the necessity being charged by the regulators. Why not we come with the optional audit? Why not we suggest our clients, or why not employer insist PCS to come with a optional audit under RPT audit, corporate governance audit, or like this. So we are coming with a series of webinar. Today is the RPT. I hearty welcome to Madam Savitri Parikh and Madam Amita Desai. Let me introduce first Savitri Parikh, Madam. Everyone knows you, Madam. Everyone knows you since last two or three decades, Madam. Madam is over 25 years of experience in corporate world, and Madam is currently Company Secretary and Compliance Officer of Reliance Industries Limited, one of the most grown industry in the country. She is a specialist editor of A. Ramaiah Guide to Companies Act 2015. We all know that A. Ramaiah is the Ramayana for Companies Act. She is also general editor to MC Bhandari Guide to Company Law Procedure 2015 and 2018 editions, and a book on listing regulations, all published by LexisNexis. She is also a guest faculty at IIM Kolkata, ICSI, ICAI, and various Chamber of Commerce. Madam is recipient of Chevening Scholarship for Young Indian Lawyers and gained exposure to European law. Madam, I welcome you once again. I have a privilege to welcome Madam Amita Desai also. Madam Amita Desai is a practicing company secretary since last 27 years. She is also IP and CSR consultants. Madam is also appearing always in NCLT matters and in practice in Companies Act and IBC. She is also a regular faculty at ICSI and ICAI and various chambers. She is also writing regularly the articles and which has been published in our institute also. Madam Amita Desai, I welcome you once again, Madam. So friends, the today's program will be like this, that 30 minutes will be addressed by Amita Desai, covering the LODR aspects for listed company, and also the impact of RPT in the recent amendments about the unlisted companies. Then Madam Savitri Parikh will address us, and Madam Savitri Parikh and Madam Amita Desai both will address us and point it that why is the RPT audit is necessary for a corporates, and what are the benefits and what are the scopes to be covered by a PCS during the RPT optional audit. So, Madam Amita Desai, I am requesting you to address us first again for next 30 minutes. Madam Amita Desai, please.
Yeah. Thank you so much, Sandeep ji, and thank you, Institute ICSI, for giving this opportunity. Thank you, Savitri Madam, and it is a pleasure to share dais with you, always looking forward. And I would like to start with the PPT, and I'll present the PPT. Give me a minute. I hope I'll try to cover within 30 minutes, but I may skip some slides which may not be required. I think everybody has all the amendment which has been prescribed by the SEBI. I'll try to cover whatever maximum in the given time given to me. First, starting with the disclaimer, whatever I am presenting is my knowledge sharing only, and it is not the institute or NCA or anybody's view. It's a personal view. The topic today is what is the scope and the necessities of RPT? Why RPT is so important, and why it has been always discussed that it is very critical and cumbersome, and even the regulator is trying also to cope up with the various nuances which the fraudulent corporates sometimes use this particular method for corporate and financial fraud. So to begin with, I think most of the country and economy is depending on the business, and business are as a entrepreneur business will be more on the corporate as a company, and business is thriving, then only the economy will thrive. But what is the ethical business? Because we have seen number of fraud in the past also as a history of mankind or history of our country also or across the globe. Various frauds have happened, and that mostly trying to regulator will try to come up with some kind of amendment to curb those wrong practices. So legislation is always dynamic, and that's how the SEBI is coming, and the Ministry of Corporate Affairs is also coming with time and again with the new changes and amendment. But we as a professional, we should think, and the society also believe that the professionals are the trustee of the society and its resources, which are being used by corporate for the benefit of the society and the mankind. Maybe it is out of a profit also, but then the planet, profit, and people all are important as we see. Now, critical RPT is critical because the use of RPT is maximum in kind of a financial fraud, as we said in various fraud which we have seen in last 1 decade, Satyam, Sahara, Nirav Modi, Gitanjali Gems, everywhere. I think this RPT route has been used for financial fraudulent practices, maybe creating a web of corporate structure. Then the significant or ultimate beneficiary owner is entity outside the tax haven, and that's how the money is transferred, and if money doesn't come back to India. Transfer of assets, undervalue the assets and transfer to the related party or the subsidiaries, and then write off or the declare as an the bad debt. Over invoicing to the related party and allow them more money to be given, maybe higher salary to the relative of the directors or promoter. Procurement of the cheap material also at a higher value, round tripping, and a lot of other loans and advances which is never coming back in interest or the principal. And that's how the RPT is a route which has been used for the financial fraud. And so the regulator and professional should be very vigilant, and we as a professional should be more vigilant for our audit when we do this kind of audit. Recently, why it is highlighted, because ESG is a buzzword of the day: governance, environment, social, and governance. Now, corporate governance is basically nothing but internalize about your integrity and transparency, how the corporate will think that ethical business is being done by them. And the related party transaction and its disclosure is an indicator for the ethical business, which will sometimes build a trust image also, and people trust more such company which are transparent in disclosure, which are fair and correct also. So coming to the, always we start with why, how, and what we want to do. So why we want to do, or why the regulator want to do this kind of RPT provisions. So always people prefer to do business with their own people, known people. That's a rule actually. People feel comfortable if they are knowing some related party and doing the transaction. So per se RPT is not bad in law, but only thing there is a conflict of interest, and somebody has to see neutrally that it is in the interest of the company or at the cost of the company and the shareholders, because this provision is abused number of times, as we have seen in the past various fraudulent incidents. So RPT is such kind of a very easy mechanism to siphoning of the money. Now, to curb this, what government is regulating, how government can regulate, how it can be done. So there has to be a process of transparency, disclosure, and somebody is taking the justification that why it should be done, whether it is an arm's length, ordinary course of business, we will see everything. And I think in the New Companies Act 2013, this has been elaborated. In 1956 Act, there was only 297, and Section 314 was mandating the related party transactions or the contract with parties or loans and advances under 295. Under Companies Act 2013 and the LODR, there are three mechanisms. First is the audit process. There is an audit committee which will look at it. Then there is a board approval also if required, and there is a shareholders approval. Now, central government is not looking into any kind of approval, which under 1956 Act, they used to do under 297. The contracts should be approved by the central government. Now it is left to the wisdom of the society and the stakeholders. Now, what one should look at it when we do audit or when we approve or the independent director will approve, they definitely will take a very conscious and informed decision. They should have everything in place of them. I mean, before them, they should have the detail of the terms, condition, related party, their capability, their experience, and then decide whether it is an arm's length, ordinary course of business. So all those criteria, that process is how and what is that should be covered in our related party and the related party transaction audit. To start with, related party is a 3-level, I think we can discuss. As a company level, we have to identify who are the relatives. Management level, we have to identify, and at the individual level also we have to identify. Companies Act says, and the LODR also prescribe that related party are those party which are mentioned under section 2 subsection 76 of the Companies Act. Then you have to look at the accounting standard, Ind AS or accounting standard. And SEBI LODR also recently been amended with the new definition of related party and related party transaction both. I don't want to go in detail about this related party. At the company level, broadly, we have to bifurcate all subsidiary holding, fellow subsidiary, associate. When we discuss about the audit and the challenges, we'll identify how the associate to identify is so challenging because there's a control, there is influence, and how one can identify whether it is a control is there or not. And recent amendment is that entity forming part of the promoter and promoter group are also related party, or any entity which is forming more than 20% of the equity shares are also related party. Going forward from 1st April 23, it will be 10% of the related party. For the definition of the related party, entity which are holding 10% will be covered. At the management level, we have to identify as an auditor and as an internal company secretary or any professional, be the auditor or the internal, they have to identify and find all detail who are at the management level are considered as related. So these are the list which is given under the Companies Act also. It's very simple when we look at it, but when we actually put in the data and gather the data, it's a very tedious task and it's challenging. It's time consuming too. So directors and KMP relatives, then their KMP and relatives of the holding or subsidiary company, firm, private company, public company, body corporate, and so on and so forth. The list is going on. Then there are related parties at the individual level. At the director level, he has to give disclosure about all his related party, HUF, his spouse, parents, and children, and brother, sister. Now in the companies, I mean LODR, the new definition prescribed person who is forming part of the promoter and promoter group, disregard of whatever his shareholding he is holding, is also a related party. And going forward from 1st April, this threshold for the person who are not promoter group from 20% will be reduced to 10%. Whether they are holding directly or as a beneficial interest holder under section 89 of the Companies Act. And further, Ind AS defines some more detail about the individual level. It covers a domestic partner, their children, their dependent, spouse, and the domestic partner himself. I don't want to go in detail about the related party under accounting standard 18, but one has to see in the accounting standard 18 and Ind AS 24, what is a definition of the related party. And the identification of related party that's how it's very wide, and SEBI want to cover some more wider, and that's how this definition has been amended. In AS 24, again, the related party, I'm just skipping this slide because it's been just shared for the knowledge. I don't want to run through. Touching upon this main important notification, which is the 6th amendment of LODR, where SEBI has widened the gamut of the related party and related party transaction. They have strengthened the process by taking a prior approval of the audit committee for unlisted subsidiaries also, and listed subsidiaries where it is a material contract or material subsequent material modification in the material contracts or the transaction. Then the approval of the audit committee is only by the independent directors, not the other members. 2/3 of the committee should be independent directors. So focus is only independent directors should take such kind of an approval, and cognizance and onus on such approval of such a related party transaction with the justification. So we'll come to that. Then the materiality threshold for the transaction with the related party. I mean, that's something we will discuss later when Savitri Madam will be speaking. I think this is a question which I also have. At one place, it is a material threshold is defined under Regulation 23(1) as a transaction with related party and where it is not a related party transaction. So that's just, I think it's just an error or it is purposefully done. We'll discuss that also. So materiality threshold has been reduced from 1,000 crore or 10% of the consolidated turnover of the company. And there is an enhanced disclosure. We'll touch upon in detail also. And there is an enhanced disclosure which has to be applicable from immediately from April 1st, 2022, and then later 2023 also. It's a phased manner. So what was the related party transaction? I mean, related party definition under prior to this amendment of 6th amendment to LODR, it was simple that whatever has been defined under 276 plus whatever is defined as a related party under accounting standard and the promoter or promoter group holding 20%. Now this has undergone complete change. It remains still the related party is related party which are defined under 276 of the Companies Act and applicable accounting standard. But here further, they have defined that it covers a promoter and promoter group without, even they don't have any single share, then also they are considered as a related party. And other than promoter, any person or entity holding 20% or more in the equity shares are also related party, whether they hold directly, indirectly, and going forward, it will be 10%. Again, related party transaction has also undergone a lot of change, and basic remain the same. The transactions can be related party transaction if there is a transfer of resources, service, or obligation to any person, disregard of the price, whether you charge the price or don't charge, but it is considered as a related party if the transaction is on one hand is a related party, I mean the listed entity or any of the subsidiaries, and other hand related party of the listed entity or any of the subsidiaries. Now, I don't want to touch upon the transaction which will be effective from 1st April 23 because it is very scary and we all are challenged. I mean, finding it so difficult to identify, but that's how it is currently. It says that a listed entity or any of the subsidiary on one hand, and on the other hand, any other person or entity which is third party, but the purpose and effect of the transaction is to benefit the related party of the entity or listed entity or it's any of the subsidiary. And then this transaction also will be considered and coming under the gamut of the related party transaction, and all process of approval and the disclosure will come. So currently the new regulation, it says related party transaction should be approved by the listed entity if there is a transaction with the related party of the listed entity on one side and the transaction with the related party of any of the subsidiary of the listed entity. Similarly, if the subsidiary of the listed entity is having any transaction with the related party of the listed entity, subsidiary of the listed entity having transaction with the any of the subsidiary of the listed entity. And going forward, these two more for the purpose and effect will be also covered. Certain transactions are exempted and it does not require because it is equally given to all. Like example, issue of specified securities under ICDR regulation, any corporate action which is uniformly applicable to all the shareholders, like dividend and securities, bonus, right issue, etc. And for a bank and NBFC company, anything has been given uniformly and the fixed deposit is taken or fixed deposit is taken, then the terms are applicable equally for all public, then also it requires, it is exempted, but we have to remember that subject to the disclosure of the same. So there is exemption in the approval, but the disclosure, there is no exemption. Touching upon the section 188 of the Companies Act, there are 7 transactions which says that these are the related party transactions. So I will skip this. These are all mentioned under the section 188. And the 188 also says that board approval is also not required if it is everything is in ordinary course of business, arm's length. Members approval will be required if there is a exceeding some threshold limit which is given under rule number 15 of the company's meeting and its powers, meeting of board and its power. So that is also to be taken prior approval, and certain transactions are exempted between the holding company and the wholly owned subsidiary. Interested members should not vote, but exemption is given to the private limited company. And then there is a disclosure in the board's report about the justification of such transactions, and there is an entry to be made in the register of contract. Now, Rule 15 says about the threshold limit, which also I want to skip that because the transaction are 7 transactions where the threshold limits are depending on the turnover and the net worth of the company. And for a related party, 2.5 is a place of profit of any of the subsidiary company or any person, and a monthly remuneration exceeding 2.5 lakhs per month. Touching to the regulation of Regulation 23 of LODR, There are 9 regulations, very simple. First is talking mostly on the policy of the materiality of RPT, and the material threshold has been defined. Second is approval of the audit committee, the way how it should be. Third is the omnibus approval. Fourth is approval of the shareholders, except there is an exception carved out for the resolution plan if it has been acquired by any company under section 31 of the IBC 2016. Then there are exempted transactions, which we have discussed, or we will go and discuss about the government companies transaction. Anything which has been notified is always a prospective transaction. That clarification is there. Regulation 7 is deleted, where the resolution, I think related parties shall not vote to approve. That part was repeated, so that is redundant and so deleted. Regulation 8 is for the approval of the shareholders, and then last is a disclosure in the format prescribed to the stock exchange and the website disclosure. The most critical part in the related party transaction, which is currently the 6th amendment has come, it says about the material transaction and the materiality decision to be taken. So with respect to the related party, in one financial year, if the company does any transaction with them which exceed 1,000 crore or 10% of the annual consolidated turnover of the listed entity as per the last audited financial balance sheet which is available, and whichever is lower, which is I think question for many large corporate, including Reliance or many Mahindras and many other companies also, where the threshold of 1,000 crore may be hardly 0.1% or 2% also. So that for that reason, they may have to go to the shareholders for the approval. Second is a payment of the brand for the brand usage and the royalty charges. The threshold is 5% and that remains the same. Approval route or the approval method is prescribed under the regulation 23. It says audit committee prior approval is required for any related party transaction and subsequent material modification also. And the audit committee will determine what is the material modification. Board approval is required only if there is a transaction which is not in the ordinary course of business at arm's length. Shareholders approval will be required and whenever there is a material related party and subsequent modification to the material related party. But audit committee is also given some power where there is an omnibus approval is given. There is no specific approval required. Year to year, they will give if omnibus approval means where there is a repetitive transaction, which they can foresee that such transaction will keep happening. Then without any limit, they can approve at X amount for year to year. But only thing is an annual approval. For unforeseen transaction, the value should not exceed 1 crore and each transaction, there is a separate contract. Then for the value of the transaction is for per transaction value. And when there are several transactions in a single contract, then as per the contract value, the transaction is 1 crore. Then how and what they do when they approve the omnibus approval are certain criteria, which again, I am just skipping it because they have to look at all the details because audit committees of independent directors and they have to go in detail about various detail of the related party name, whether what is the period of transaction, what amount we are approving, what is the base price and what is the formula if there is a change in future and such other whatever they feel is adequate for them to review, and they have to review quarterly these omnibus approvals. Effective from 1st April, now the role of audit committee is expanded tremendously because independent director sitting on the audit committee, they have to not only approve the related party of the listed entity, but also all the related party and subsequent material modification also required. And audit committee shall also define what is the material modification. Not only that, they have to give a prior approval. Now, where the prior approval of audit committee is required, when we have seen or the regulator might have seen that there is a leakage or there will be a transfer of the assets and the fraudulent activity happens when there is an unlisted subsidiary and the unlisted subsidiary is transferring the assets and it's not coming back. So for that reason, sorry, I think I'm skipping that. I'll just discuss about this prior approval of the audit committee is required for transaction which subsidiary company of the listed entity, when listed entity is a party, but the listed entity is not the party. Sorry, subsidiary is the party and listed entity is not the party. It shall require prior approval only when the transaction value is exceeding the threshold of 10% of the consolidated turnover of the listed entity as per the latest audited balance sheet. Now going forward after next year, 1st April 23, this threshold will be considered as per the 10% of the standalone turnover of the subsidiary company. So that means the threshold will be maybe very nominal, very minimal than the consolidated. So that's an additional burden on the independent director. Prior approval of the audit committee is not required in case where the subsidiary is a listed subsidiary, and listed subsidiary is party, but the listed entity itself is not the party. Then prior approval of the audit committee of this entity is not required. If the listed entity is governed under Regulation 23 and 15 sub-regulation 2 of the LODR, then not required. With respect to 22nd November, there is another circular which SEBI has given, which defines or which prescribe about the information to be placed before the audit committee and the shareholders for deciding such related party transaction. And the most critical is the justification as to why the RPT is in the interest of the related party and the interest of the listed entity that has to be taken care. And also they prescribe the format of related party disclosure every half yearly, 6 monthly basis, and the time has been distinctly changed for the high value debt listed company and the listed entity which has a prescribed their specified securities other than this high value debt. Now, what are the information to be provided to the audit committee? We as an auditor need to understand, so that when we do audit, we should review whether the audit committee is really given all this information before they approved any related party, because that's a very critical. So broadly, there is a type of transaction, name of the transaction, name of the party, what is the relationship, what is the concern and interest, is there any conflict of financial or otherwise, tenure of such transaction, value of the transaction, percentage, and transaction related, all details should be given. Similarly, information to be provided to shareholders is also prescribed in the SEBI circular, which gives similar detail to be given to the shareholders before they decide for the related party transaction. Now, prior approval of the shareholders of related party is required at certain places. Prior approval of the shareholder of listed entities is definitely required for all material and subsequent material modification of transaction of the listed entity, but also for any unlisted subsidiary where the listed entity is not a party. Then also, if the materiality threshold is exceeded or any subsequent material modification will happen to those transactions, then prior approval of the shareholders of listed entity will also be required. Now here there will be the first general meeting which will happen in 2022 by September latest. There we will see number of such approval will be put before the shareholders for the approval. And no approval of the shareholders of listed entity is required if the subsidiary is also listed and it is governed under Regulation 15(2) and 23. Now, no related party, whether party or not, they should not vote under the such kind of an approval put before the shareholders. So that means promoters and their relatives and promoter group will be out, and so the shareholders, and maybe we are seeing the shareholders activism recently and proxy advisory firm, they will be taking this approval, and when everything is placed before them in detail about, then they can take a proper informed decision whether to vote for or against. Again, exemption here is a resolution plan or resolution plan under IBC. Moving to 8th April, another circular where the shareholders' approval to be taken, people have approached to and the representation has been made to SEBI. SEBI has come out with the clarification, but I think here this clarification is not, it's more confusing in fact. It says that the shareholders' approval for the material omnibus related party transaction, whenever it requires this year, it should be approved in the annual general meeting, which shall be valid for the date of the next annual general meeting. And the next annual general meeting should be normally held within 15 months. So that means AGM to the next AGM, you can approve. And if it is approved in other than the AGM, that is any EGM, then the validity is just 12 months. But the question may come that RPTs are calculated as per the financial year and not from AGM to AGM. So one has to decide how to pass the transaction and how to record the transaction and the use of the language when you approve, get the approval from the shareholders. There's an exemption given under Regulation 23, certain transaction between two government companies, and as government company defined under Section 2, subsection 45 of the Companies Act. Any transaction between holdco and the wholly owned subsidiary when the consolidation is going to happen and the shareholders will be reviewing the balance sheet and approving. And the third is the recent amendment which says that any transaction between two wholly owned subsidiary of the listed holding company, where again the accounts are consolidated of both these companies and put before the shareholders. I don't want to touch on the proxy advisory forms, and we have seen a number of cases that the such kind of approval, when it is placed before the shareholders, it may get defeated if it is not found in the favor of or in the benefit of the shareholders or the company. Now let's touch upon just for 5 more minutes. I think I can take 5 minutes, Savitri madam.
Please go ahead.
Yeah, so I'm coming now with this background. Let's do and discuss about, as a professional, what kind of an audit evidence we should generate or we should keep for us, and what is the process we should follow. So it's not easy, because earlier we start with the appropriate or not, then adequate or not, now absolute, but now we have to see complete and fair disclosure is being given, and basis that the decision is taken by the independent directors, and we review all those things. So smaller companies, I think there are difficulty because there is no control environment, there is no ERP or the software used for the SAP or anything where it could be identified like a big company. So there the challenges may be more. Manually, it will be really difficult to identify the related party. The way it has been expanded, it takes its own time to create the database. So let's touch upon what kind of data we will gather when we go for the audit. So check whether the listed entity is listed with the specified security or it is a high value debt listed company entity. Though it is mostly, it is covered, the regulations 17 to 27, everything is applicable to high value debt listed also, with certain exemption that one has to take care of. Understand the structure of the organization, whether the organization has a SAP or ERP system. If it is not, then really it is challenging. Even if it is there, then also whether the process of identification of related party and how frequently it is updated in the system is also a big task or a challenge. You can test some RPT as an identified, and whether how it has been coded also in the ERP system. One may need to hunt for the undisclosed RPT, because you can't say that I am just outsiders and I depend on some MR letter or something, management representation letter. That's not, doesn't work. You have to check on your own with your wisdom, understanding, and find out whether there is any undisclosed related party or related party transaction, and try to capture in your framework when you are preparing with the true fairness and completeness, though nobody can claim that it will be a complete, because it's a Herculean task and it may take its time to evolve the process. Even the big companies are also finding difficulty to identify. The reason being that the promoters are not mandated to disclose their related parties. Promoters could be anybody, individual or body corporate, and then it may be a challenge. Directors are, to that extent, on BP1, they give disclosure, but there also there are certain challenges. We'll touch upon that. Now, list of relatives and related parties of all the subsidiaries also included, including the associate, individual, venturer company and the investing company. Then a list of the current RPTs and past 3 years RPT one should go through, review, so that the understanding will come that about the organization, how it functions, what kind of process they have followed, what is the threshold and why it is being happening. So some business acumen should also be developed when we review this related party transaction. And then prepare your database and document the same. First, there is an insistence, I will again repeat, there has to be some documentation of your complete framework of identification of RPT. List of promoter and promoter group, disregard of the shareholding of the company. So you have to identify what are the promoter group metrics which has been approved by the company, and who are the promoter and promoter group. One more important is a vendor approval process. Just check the vendor approval process, and in ERP also there has to be a coding to be given for such related party transactions or related party. Vendors are related party, so that the threshold limit is also identified when they are crossing such certain threshold limit, and whether the update of this system changes or not, that also one has to look into it. Then you review the materiality policy, of course, that's the first, and material modification identified by the audit committee. Form MBP1 sometimes helps, it doesn't help in detail, because many a time directors does not disclose their shareholding in a startup company, angel investment. They feel it is not required, but any single one share in a private limited company, they have to disclose. For a public company, it is a 2% or more threshold. I mean, more than 2%. But for private company, one single share also they have to disclose, which they are not disclosing many a time. That's a practically, I think I have also seen. PAN number of all such related parties should be matched in the ARP system with the folio number if possible, so that we will come to know whether they are members or the promoter group. Review the omnibus approval given by the audit committee. ask for the organization structure of all the related party, if it is an entity and their ownership and SBO, you live the corporate veil and find the nature of the relationship. I'm not saying that we should be a bloodhound, but we have to be a watchdog and we have to be careful when we do. Then of course we have to review the audit committee, the minutes and all minutes, register of contract, disclosures given in the past, report disclosure what they have given in the stock exchange without netting off or the clubbing of the transaction. We have certain questions there also later on. Then disclosures by the banks and NBFC for acceptance of fixed deposit. They have to disclose. There is no need for approval, but disclosure is required. Then internal audit report will also give some kind of idea when you do audit, whether is there any loophole in the financial control system, whether the data is not checked and balanced and there is a lacking somewhere. Check the detail of loans and advances, any writing of what cost we are giving, what is the use of that loans and advances given terms, which is mandated now by under the LODR by SEBI, about the terms about the security covered or not and purpose of utilization. There has to be a process to identify and review transaction with the foreign material subsidiary, which is a big challenge. If there is a subsidiary overseas, how do you ensure, though it is a more for independent director, but as an auditor, what kind of a supporting document and translated document you need for understanding the contract with them? Then meeting the person or the account who are responsible for such kind of reporting. Check the process of approving, what level and whether they are frequently meeting happening with the internal auditor and the audit committee. Analyze the RPT. Then relevant information are shared with the audit committee or not audit. Sometimes it happens, it goes just 2 days before to the audit committee. Audit committee cannot use their wisdom to review all the related party transactions. Though now I think this has been changed and we will see some more change here by when the audit committee and the independent directors need to justify also that it is in the interest of the company. And then how independent different departments are all sharing the data also, whether any exemption for a private limited company, is there any exemption of 5th June 2015 amendment is still available if they are not delayed in their filing of annual filing for more than 2 years. Then website disclosures and disclosure which is given in the Schedule 5 Part A. And now I think the most challenging work we all have to look into is a reclassification of the transaction, which are not the contract, but the transaction where the materiality threshold be due to the change in the materiality threshold, whether they need to go to the shareholders for the prior approval or not. You can also give and discuss openly with the management before you start your audit about what are the process of identification, who are the promoters who are giving such kind of, develop a template where everybody has to give compulsorily, or you slowly request them and take the related party detail. Find out the background of the related party, what is the justification or rationale the management has, you understand that also. Any change or modification or sudden change or writing of any such contract also will give you some idea of whether it's irregularities happening or not. Review process of approval and the risk management policy is also very critical to check the modalities of such kind of risk for any misstatement in the financial, because if any related party transaction is missed out in the financials, it will be a misstatement of the financial. And so risk assessment policy will also have some kind of a process or the SOPs to mention that at what level and who will be reviewing regularly. Then in the process, you collect all the evidence, communicate to the audit team, take the step if you find a fraud or irregularity, review the disclosures, supporting document, which is the most critical to back the views of the management on transaction at arm's length and ordinary course of business. Then a management representation letter design. And I think I'll just touch now the challenges, 5 more minutes, not more now. Or we can take it last, but I'll just give the idea and thoughts for the clarification which people are having in as a professional audit firm. Like MVP1 doesn't disclose, as we discussed, investment in the startup and angel. There's no mandate to promoter, director, KMP for giving disclosure of their related party. If ERP system is not there, then it's a challenge. No document is also in support of the proof that it's a transaction is an ordinary course of business and arm's length. Identification of any company or entity which is having a control and significant influence is again one more challenge. I have seen register of contract covers contract only 188 2 and 184 2 also, but sometimes people are saying 188 is not applicable because it's an ordinary course of business, arm's length, so there is no need for making any entry. That's a wrong stand. Quarterly monitoring by the audit committee is also not done in a small companies. And transaction, no need for the board approval if the board is, many times the transaction which is in ordinary course of business, arm's length is there is no need for the board approval. But if you are taking board approval, ensure that it is taken with the proper 184 compliance. Granting of loan and guarantee cannot be considered the omnibus. Hello? Sorry. Hello? Can I go?
Yes, please go ahead. Yeah, please go ahead.
Yeah. Then the 5th June exemption of the private limited company has lost due to delay in filing, that sometimes people don't check and that's a mistake. There are exemption also from obtaining approval for certain RPT, but disclosure is required. It is left to the discretion of the audit committee to define material modification. Investing company, bank, insurance, if they are holding more than 10%, then they are considered as a related party. But what about the entities controlled by such company? Whether is it a related party or not, no clarification. I think I'll skip this. And purpose effect also I don't want to touch. It is opening a debate for separate session is required. Just last NSC, when they gave a FAQs on 25th April, there is some confusion which I think Savitri Madam will touch last. And with this, I think I'll stop my sharing of, I'm over timing by 10 minutes more. I think with this, my presentation, and then if time permits, I'll suggest what are we as an auditor will be suggesting to get some document from the company and management. Thanks a lot. Over to you, Savitri Madam.
Yeah. Thanks, Madam Amita Desai. Your marvelous presentation, marvelous, Madam. Thank you, Madam. And you have covered all the LODR, its amendments, various circulars by SEBI, then Companies Act, then rules. You have covered all these in one chapter. Thank you, Madam Amita Desai.
Thank you.
Yes, Madam. Over to you, Madam Savitri Mari. Madam Savitri Mari, please.
Good afternoon. Thank you, Sandeep ji. Thank you, ARC, for granting this opportunity. It's a very important topic on which we're going to be having this discussion. And my special thanks to Amita for making a very comprehensive presentation. The time allotted to her was quite short, but at the same time, she's made it as comprehensive as one could be. It's made my job much easier, I would say. Some of the points which have been covered, I would just like to elaborate a little more on the points and take it forward. Yes, indeed, the amendment made by SEBI in the 6th amendment to LODR in 2021 is the most important one because it has far-reaching effects. But let me just try to dissect some of the points. One is, of course, with respect to definition of related party. Currently, any member of the promoter group would also be considered as a related party and irrespective of the shareholding, which basically means if a person belongs to the promoter group, even if the shareholding is not there, or maybe even one share in the company, even then such a person would be treated as a related party. So here, earlier there was this threshold, which threshold has now been done away with. And even a party which is not part of the promoter group, but holds 20% of the share capital of the company will be considered as a related party. Let's now look at a practical example. And before I go into that, let me just explain the term listed company. Section 2, subsection 52 of the Companies Act defines the term listed company, and effective 1st of April 2021, there was a proviso to this particular section which got added. And just to sum it up, it would now cover under Companies Act, only equity listed companies would actually be covered in the definition of listed company, which basically means if there is a private limited company which has its debentures listed, non-convertible debentures listed, the private limited company will not be considered as a listed company for the purpose of Companies Act. However, if you now go to LODR provisions, because of the definition of the term high value debt listed company, if this private company has, let's say, issued debentures worth, let us say, 600 crores. This private limited company becomes a high value debt listed company. For the purpose of understanding related party transactions, let me take this example and build on it. Let us say this private company, which has 600 crores of non-convertible debentures, has 10 shareholders. Let's say Mr. A, Mrs. A, Mr. A1, Mr. A2, Mr. A3. 5 members of the family holding 95% of the share capital of ABC Limited, which has 600 crores of non-convertible debentures issued. And let us say the remaining 5 shareholders hold balance 5% of the share capital of this ABC Private Limited. Now, this ABC Private Limited, being a high value debt listed entity, will be required to comply with Regulation 23 of LODR. And let us assume there is a transaction between this ABC Private Limited and a related party, which is on arm's length. Even then, it will be placed before the shareholders for voting thereon on this particular item. And assuming that the remaining 5 shareholders who hold 5% are not on good terms with the 95% holders, they are the ones who are supposed to be approving, because you require majority of minority. How is it different from the provisions of Companies Act? Under Companies Act, there is a very specific proviso which says that if more than 90% are related parties, then the provision of non-voting by the related parties will not apply to such an entity. And in this particular case, because of the company being a high-value debt-listed entity, majority of minority provisions will get attracted, which basically means this 5% holders will need to approve. Now, 5% holders would effectively mean even if 3% holders are opposed to this particular transaction, they will be able to ensure that the transaction does not go through. And I'm actually presuming that the remaining 5% attend the meeting fully. Let's assume only 2 shareholders holding, say, 0.1% attend, and both of them vote against. The transaction does not go through. So this is one where high value debt listed entities will actually get affected if there are difficulties and the entire holding is not by the same entity, but by the same family in case of private companies which have gone for listing and which needs to be very carefully looked at. Coming back to the point of related parties, with this threshold of 20%, let me once again take the example of a public limited company, which is not an equity listed company. And it is very common to have private equity participation. And maybe the private equity participation is, let's say, to the extent of 24%. In such an event, any transaction between the company, and I'm assuming this private limited, assuming this public limited company is debt listed, covered under the NCS regulations, and assuming it has debentures of, let's say, 1,000 crores, this particular company will need to take approval of its shareholders, majority of minority, with respect to transactions with this private equity. And the private equity being the other party, they would be related party, and therefore they would not be entitled to vote. What if all the shareholders are related parties? There is no specific carve-out presently, but I'm sure this will come through as we go along, because it's quite possible that in a public company you have nominee shareholders, and or maybe the same family holds shares and you have a private equity which has invested. Suffice it to say that with respect to high value debt listed entities, applicability of Regulation 23, one would need to see as to how exactly it will pan out, because majority of minority is going to be a little tough in such cases. Yes, Amita did touch upon purpose and effect, which is going to come into effect only from 1st of April. Of course, before that, I'm sure there would be some guidance on this. we will necessarily need to get some kind of a bright line test as to how exactly you determine purpose and effect. Otherwise, just in terms of the wordings, it's too broad. Say, for example, a company holds 90% of the share capital in the other company, and that other company enters into a transaction with the listed entity. One can say that the company has the share capital, and therefore any transaction with that subsidiary will benefit the company. It's not a wholly owned subsidiary. Would you then say that the purpose and effect is to benefit the listed company? The listed company is, of course, going to be benefited monetarily. So how exactly do you determine what would be said to be not in the interest of the listed entity? Because anyways, 90% of this particular subsidiary, if the holding is 90% of it is anyways going to be consolidated in the main company's financials. Actually, there'll be a line-by-line consolidation, so the entire thing gets consolidated, and the effect is to the extent of 90, one can say. But this is a very, very generic term. I think some more clarification on this is necessary. Term material related party transaction is what we all have been grappling with. And in the definition, which is given in Regulation 23(1), the explanation says as to when a transaction would be considered material. Now, the term used is when will a transaction be considered material? Now, I just explained about the definition of related party. Apart from this, related party does not cover anything else. But if you go to the term related party transaction, it says entity or its subsidiary with the related party of the listed entity, or subsidiary with any of the related party of the subsidiaries, which basically means related party transaction scope has been widened substantially. It will not only cover transactions by the listed entity, it will also cover transactions where the listed entity is not a party and only the subsidiaries are parties. Of course, there is a carve out with respect to listed subsidiary, which I'll come to in a minute. Now, the point here is where the subsidiaries and related parties of the subsidiaries are all taken into account. Let me put it this way. If I were to explain this simply, I would say that I'm reminded of match the column of our school days. On the left-hand side, I plot the listed entity and the subsidiaries of the listed entity. What does the term subsidiary of the listed entity mean? All of you are aware that subsidiary, the term has a meaning under Companies Act. It also has a meaning under the accounting standards. So which one would you be referring to? I have no doubt in explaining that you would have to go by the provisions of Companies Act only. Why? Because LODR very clearly states terms not explained in LODR, terms which are not defined in LODR, one would go by the provisions of Companies Act. So on the left-hand side, you would have the name of the listed entity and all its subsidiaries under Companies Act. On the right-hand side, please put names of the related parties of the listed entity and of all the subsidiaries. And please do match the column to see who's dealing with which entity. Once you get a line across, all those transactions need to be then checked. And I'm not saying all those transactions need approval, because the second proviso to Regulation 23(2) has also to be considered. This is also required to be considered. But before that, once you have drawn the lines, you will need to see wherever the listed entity is transacting, you will require approval of the audit committee of the listed entity, because the listed entity is a party. So once you've drawn the lines, you need to have two categorizations. One, transactions to which the listed entity is a party. Two, transactions to which the listed entity is not a party. Of course, in the second basket, you will also need to have a further highlighting done of transactions where the listed subsidiary of the listed entity is a party. But before we go into complexities, let us look at the simple one itself, where the listed entity is a party. Nothing has changed. Even earlier, the LODR provisions required under 23(2) approval of the audit committee to be taken. From the 1st of Jan 2022, this approval is required to be taken of independent directors on the audit committee. A very important question that would come up is, how do you record it in the minutes? What if the independent directors who are members of the committee have approved and one of the other members who's not an independent director has not approved? Maybe the situation would be rare, but if such a thing happens, how do you record it in the minutes? Because you only require approval of the independent directors. So here, my suggestion would be, no matter how the approval has come through, please put 2 specific sentences. If you do not have, if you have any person who's not an independent director, specifically state that the resolution has been approved by all the directors, or maybe has approved by, or has been unanimously approved by all members of the audit committee. Now, when you say unanimously approved, it obviously means that the independent directors have also approved it. If you do not write unanimously approved, it actually leaves open a small gap as to whether the non-independent directors have approved or have disapproved. It's a good governance practice to specifically cover everybody. Assuming for a second, unfortunately, there is a disagreement, please specifically state it in 2 separate sentences so as to ensure that there is absolutely no ambiguity on this. And I'm sure that there would be a question. And of course, in most cases, if the independent directors have agreed, it is presumed that even the others would have agreed. However, please ensure there is a specific sentence. The other point here is, of course, it's a very small minor technicality. 23(2) says it needs to be approved by the independent directors who are members of the committee. The second part says that with respect to related party transactions, okay, you require, the related party transactions with respect to the subsidiaries where it exceeds 10%, it says approval of audit committee, which is post this particular provision, which requires independent directors only to approve. So if it concerns the subsidiaries, does it mean that all of them can vote? I would say it's a very small technicality. The same intention is to ensure that it's only the independent directors who vote. However, as I mentioned a little while ago, ensure that if it is unanimous, specifically mention it so. With respect to transactions where the listed entity is not a party, but the subsidiaries are parties, there is a threshold which has been given. It says that if the transaction exceeds 10% of the consolidated turnover of the listed entity, only then will it require audit committee's approval. But if you go to regulation 23(4), it refers to 1,000 crores. There is no change, which effectively means even if the transaction does not exceed 10%, you will require shareholders' approval, but you do not require audit committee's approval. Probably that cannot be the intention, but that is exactly the way it is. So audit committee's approval, in my opinion, you should take, even if it exceeds 1,000 crores, although the law says only if it exceeds 10% you require. Probably the intention was to take only such material related party transactions to the audit committee where it does not concern the listed entity but concerns only the subsidiaries, because you would anyways be taking it to the shareholders. But since the clarification is not there, if it exceeds 1,000 crores with respect to subsidiaries, take it to the audit committee. It's always good to be more compliant than have an element of doubt. The point here is, what if the listed entity is not a party to the transaction? However, the listed subsidiary is a party to the transaction. 23(4) also exempts where it says that where the listed entity is not a party to the transaction, but the listed subsidiary is a party, which is covered under Regulation 23 and under Regulation 15(2). What exactly would this mean? It is covered under Regulation 23. There are two categories of listed entities which are covered under Regulation 23. Either it should be one which has listed specified securities or is a high value debt listed entity and is exempted from and is also covered under Regulation 15.2. So if it is covered under 15.2, there are two conditions given under 15.2. One is with respect to the net worth and the other one is with respect to the paid up capital. Now, if these two conditions are satisfied, 23 would not be applicable if it is a equity listed entity. Now, the first part of it said 23 is applicable. So if 23 has to be applicable, it will only be a high value debt listed entity, and 15.2, which basically means it is exempted from the from these conditions, which means it has these concession which is available. Only if these two conditions are satisfied will it then be one which will require approval of only the listed subsidiary being taken, and one does not have to take it to the shareholders, which basically means it's a small company and therefore it is not considered to be material. That's a very complex exemption which has been given. The other point that I would like to cover is one on the disclosure which is required to be made. Under 23.9 of LODR, the disclosure was required to be made earlier, up to 31st of March 2022. The disclosure was required to be made within 30 days of publication of the results, which effectively we took it as 30 days of the board meeting date. However, although publication would actually mean newspaper publication, but one did not go into such specific but yes, it actually means publication would mean newspaper publication. The time period was 30 days. However, that has now been reduced to 15 days from 1st of April 2022. And once again, high value debt listed entities need to give their RPT details along with the financial results, which effectively means on the day of the board meeting. And the high value debt listed entities give it the same day. Equity listed entities get 15 days, which effectively means for the half year ended 31st March 2022, you only have 15 days from the date of publication for giving the details with respect to related party transactions. Of course, the XBRL is currently not deployed, it's not ready, and therefore companies have been permitted to upload a PDF file where, as per the format, the PAN numbers will not be disclosed, so the PAN numbers need not be given when you are uploading it. So PAN could be taken off and the details can be uploaded, but the time limit is only 15 days from the date of publication of the results. The format has changed as compared to the format that we had used in for the half year ended September 2021, which was the first time we'd used the format. The new format, as Amita also mentioned, is given in the circular of 22nd of November 2021. Now, this new format has several other details which are required to be filled in. For example, you're now required to fill in the details with respect to counterparty and nature of relationship. For the half year ended 31st March 2022, the clarification has been issued saying that it will be as per the law as it prevailed till 31st March 2022, which actually means up to 31st March 2022, the listed entity was required to give details of related party transactions in this 23.9 disclosure only if the listed entity was a party to the transaction, which is something which companies can adopt that same practice and disclose. If they so choose, they can give details with respect to ones where the subsidiaries are also parties. As per the old disclosure, transaction with entities which are subsidiaries was not required to be given. It very clearly stated that entities which are consolidated with the listed entity need not be disclosed, because it will actually become double counting. However, under the new format, it says you need to disclose it once. So which basically means if there's a transaction with a wholly owned subsidiary, while the transaction will not require audit committee approval, you will need to make a disclosure. Of course, when XBRL gets deployed, we will need to see whether all the fields are compulsory, because you actually are not going to have approval of the audit committee. You are not mandatorily required to have a value limit which has been approved by the audit committee. So therefore, we will have to wait and watch as to how exactly that is deployed. But assuming for a second it is not, since the law is very clear, you don't require audit committee approval. So that field, let's say, is not a mandatory field. The moment you say it's a wholly owned subsidiary, you will need to fill those details. But for this half year, you would be filing only a PDF format and would be giving the details. The new format also has opening balance, transactions during the year, closing balance. Now, typically, ledgers are maintained not transaction-wise, but party-wise. That's the way ledgers are always maintained. So you would never have an opening balance with respect to sale of goods or an opening balance with respect to rendering of services shown separately in the ledger. It will be one opening balance for the party. So therefore, opening balance and closing balance actually will become separate line item instead of clubbing it with the nature of transaction in certain cases. You will just need to see that when you're filling up. All that I would say is please spend time. It is not something which can just be done in a hurry. It's a very detailed form. And in fact, I see all the practitioners playing a very active role in getting this done. And also, you should check as to how the disclosures are made in this, how exactly the balances are shown in this particular format. What if the transaction is one where you have a combined limit? For example, you may have a combined limit with respect to 2-3 transactions with the same party. You will need to see as to how exactly you then show it. The first time around, since it's a PDF file, it will not really be a problem. You may also have a subsidiary dealing with another subsidiary where there is no consideration. Let's assume A Limited and B Limited are two subsidiaries of the company, and A Limited has a transaction with B Limited without any specific monetary consideration. How exactly would you be showing it in your disclosure? Mind you, if the transaction is one which does not exceed 10% of your consolidated turnover, it will not require audit committee approval. However, in your disclosure, everything needs to be disclosed. So therefore, this transaction will also require disclosure. Now disclosure can only be made if there is a monetary value. If there is no monetary value, is it a related party transaction? Answer is yes. If there is no monetary value, it cannot require audit committee approval. So you will actually need to see what are the transactions and which are the ones which require audit committee approval, which are the ones which post audit committee will require shareholders approval, which are the transactions which do not require audit committee approval, as I said, less than 10% but more than 1,000 crores, but require shareholders approval. Once again, under Regulation 17 of LODR, there is a specific condition which says that any matter which is placed before the shareholders should also have recommendation of the board. For the board to recommend, in case of related party transactions, they would also want the audit committee recommendations based on which the board would be able to recommend. So even if it is less than 10% but more than 1,000 crores, it will therefore need to go to the audit committee as a good practice and thereafter take it to the board when it comes as a item for shareholders approval. In fact, Amita raised a very valid point regarding definition of material related party transaction. In fact, while 23(1) refers to the term material related party transaction, the explanation refers to transactions will be considered material. all that I would say is, yes, there is a distinction in the terms. Conservatively, it is better to comply with it, because not just with respect to transaction, it also says transaction with the related party will be considered material. And if you go to the definition of related party, nowhere does it say that it will cover transactions where the subsidiary is a party. But at the same time, since the term related party transaction refers to subsidiaries, I would take a very conservative view and say that material related party transactions shall mean transaction covered under related party transaction where the transaction value exceeds 1,000 crores or 10% of the consolidated turnover of the listed entity, and ensure compliance. Coming back to the point of counterparty detail, which was also very nicely covered in Amita's presentation, it is necessary to disclose as to what is the nature of relationship. So, basically it will be subsidiary or so on. It's also important that earlier it said the disclosure document will be as per disclosure made in the financial statements, that is as per accounting standards. Now, the reference to accounting standards is not given. Therefore, you would have associate companies under Companies Act, which may not be associate companies under accounting standards. You would have subsidiaries under Companies Act, which are not subsidiaries as per accounting standards. So if they're subsidiaries, remember I said they go to the left-hand side of the match the column. And if they are associates, they would then come on the right-hand side of the match the column, and they become a related party. You may just be having 20% of the stake in that other entity, and therefore it may have become an associate, but you may not have any control over it. So therefore, having any transaction with any other subsidiary of the company, you will need to have, it is not just the consolidation, even the transactions, you will need to have complete visibility on. Suffice it to say that tracking of related party transactions is going to be a Herculean task, especially if the transaction is less than 1,000 crores. More than 1,000 crores, every company would have a filter. But remember, in your disclosure document, you're supposed to enter everything. So even if it is a transaction of, let's say, 1 lakh, it will find a mention, and you will need to have a process put in place to track all these transactions. Who are the related parties? The simple way of looking at it in terms of left-hand side and right-hand side, all the entities which are subsidiaries as per Companies Act, all the related parties as per Companies Act, as per accounting standard, if they are listed companies. If they are not listed entities, unlisted entities, please ensure you put only related parties as per Companies Act, and ensure that this particular listing is complete in all respects. That's a starting point for ensuring that you're able to track the transactions. And as I said, high value debt listed entities, there is a further complexity, and you will need to see as to the transactions which are required to be tracked. Material modifications. What actually amounts to a material modification? Let's say, for example, you have an agreement with a related party, and let us say it is a transaction where the listed entity has given a particular property on rent to another related party, and you have increased the rent from X to Y. Will that be considered as a material modification? It is necessary for the audit committee to discuss and have a policy clearly put in place with respect to material modification as to what will amount to a material modification at all. Is there a threshold? Is there a basis for determining? And that needs to be clearly documented in the material modification. The policy with respect to material modification is also supposed to be approved by the audit committee. The audit committee is supposed to have got this in place. There's another very important point. It's very common for companies to have employees as directors on the board of subsidiary companies, especially wholly owned subsidiaries. all these persons and their relatives will become related parties for the listed entity. So if the listed entity is transacting with any of these persons, more importantly, the employee concerned itself, that's also a related party transaction to which the listed entity is a party. So you need to be careful as to how exactly these are tracked, and the directors and their relatives and the companies will all need to be clearly tracked for putting them in the right-hand side of the match the column as I've been referring to. So suffice it to say that the format needs to be given a very close look so as to see as to what is required to be clearly disclosed. For example, if you have given a loan, then what is the source of fund? How exactly have you given it to the subsidiary company or the related party also needs disclosure. So any financial transaction, there are a set of disclosures which are required to be given. All this needs to be gone into. If it is not this, then the basic related party have this directory of related parties. Look at all the transactions which are normally entered into. Look at the values, amounts, and keep reviewing this regularly so as to ensure that you're absolutely in compliance. With these words, let me hand over to Sandeep ji. Thank you very much. We are not able to hear you. We are not able to hear you.
Yeah, thanks, Madam Savitri Parekh. Approx 5,000 to 6,000 participants have joined the webinar, Madam, and I have no words to appreciate you. We all are hearing you very patiently, Madam, and we must appreciate you all. Always, I have seen you to address us without any PPT, without any document, without any your paper note, Madam. Thanks. Thank you, Madam. Madam, just a small question from my side to Madam Amita Desai. That Madam Amita Desai just mentioned that RPT auditors should hunt for undisclosed RPT. Maybe the PCS may or may not have the full details in the MVP one. May the PCS full details in the accounts. So how a secretary can plan for entire RPT audit, viewing this type of details APCS can have?
Yeah, I think it's very difficult for any PCS to just blindly follow MVP1 and go. They have to keep there and review the accounts also, sit with the accountant, look at the ledger and check, and you can do some research online also. If he's a director, you will definitely get the DIN numbers and match with that. But if he's a shareholder in the other company, it's very, very difficult for any PCS or anybody to find out unless they themselves come forward and declare. So you have to just keep your wisdom and mind open of such kind of transaction. Keep thinking, look at the various minutes or anywhere where you can find, or maybe I'm not saying you have to be a bloodhound, but you have to be watchdog. You can do research online, like what we do for the disqualified director, willful defaulter. You may find somewhere there's some connection, then you may have to go a little more detailed. What I meant to say that you can't rely on the management representation letter or just simply MVP1. Try together as much as possible or small companies.
Okay, Madam, you want to add something in it? How a practicing company can hunt for undisclosed transactions? Here may or may not be.
Yeah, it's actually not very easy to look at the undisclosed transactions. Having said that, some of the basic things that one would have to do is to take a look at the ledger, take a look at the disclosure made in the annual report, because Ind AS 24 also requires disclosures. And on a random sampling basis, you would also look at the financial statements of that other entity to see whether there are any disclosures made in the other entity's financial statements. And of course, with respect to the basic information available in public domain, yes, that will also need to be done. But having said that, it is not very easy, especially if you're just a shareholder. So, annual return is another one, but to what extent are you going to be able to check all this? It will then become a, big compilation with respect to every transaction.
So, madam, there is a contradiction between regarding to rule of RPT in LODR, in Companies Act, in rules, in AS, in Ind AS. So how a employee CS or how a PCS, practicing company secretary, can handle all these things? Should be conservative or should focus more on LODR or should focus more on Companies Act? What's your view?
So do you want a one-word answer to this or an elaborate answer?
Madam,
a one-word answer, it is very difficult. Having said that, I would say that, actually, if you look at Companies Act, there's a very clear hierarchy with respect to approvals. And it says that all transactions with related party will require audit committee approval. Yes. Now, if you go by provisions of LODR also, all transactions with related parties will certainly require audit committee approval. Up to here, both are synergetic, both have synergy in this. The point here is how do you determine audit related party under Companies Act and under LODR. Under LODR, there is an additional element of accounting standards also, which is brought in. So it's only with respect to the number of other related parties with respect to whom you will need to take the approval. So that's from the audit committee approval perspective. Then you have shareholders approval under 188. It says whatever is done in the ordinary course of business and on arm's length basis, you don't require approval of the shareholders. However, in LODR, you have material related party transactions. But at the same time, now the term material related party transaction has also undergone change, and there is an absolute limit of 1,000 crore which has been brought in. So therefore, you will need to see whether the threshold is being breached or not, and it is per annum. So you will have to therefore take a look at that. And that's one where you will need to have clear visibility on how the transactions are happening. And the third one is, if you look at Companies Act, Rule 6 says the audit committee shall periodically review. But a periodicity of review by the audit committee is not stated, which is mentioned in LODR, where it says on a quarterly basis. So which means on a quarterly basis, your audit committee is required to necessarily review and see as to how the omnibus limit is being utilized by the company. Now, with respect to the further compliances, now when which is actually multiplied it is multiplied exponentially, I would say. It would not be wrong to say exponentially, because from 1st of April 2022, you are not only looking at your own transactions, you're also looking at the subsidiaries' transactions. Now, a subsidiary where you only have, let's say, 51% holding, and this particular entity deals with any other person who is a related party of the group, of any other subsidiary, then, or, maybe just an associate where you have absolutely no direct control or linkage, okay, the listed entity is supposed to have an oversight on this. So it actually makes it far more broad, I would say, and therefore you need to have all these systems put in place to be able to track it.
Yeah, madam. My question is, who can be the RPT auditor? And do you feel that a practicing company secretary would be the best one for optional RPT audit? So,
actually, it is a question of checking the processes with respect to numbers. I would say that maybe the accountants and auditors are better positioned. However, with respect to the range as to what needs to be captured, and basically what you're seeing is not with respect to the ledgers, but you're asking the details to be given by the company, and based on that you're checking as to whether the process of identifying related parties has been correctly followed or not. whether the transactions are in excess of the threshold limits or not. So if it is, it depends on the kind of questionnaire that you're using to see it. And if that is robustly done, a company secretary in practice can certainly do it.
Thank you.
Amita, would you like to answer?
Yeah, I believe the PCS is more qualified disregard of the numbers. We don't want to go in the numbers, but with respect to the process, with respect to the detailing, I think they would be the right person, except there has to be a robust system in the company also, where the identification would be easy. But I believe instead of chartered accountant, company secretary would be more relevant, because knowing the detail and complexity of the information to be given to the audit committee, whether the justification to be given. So all this documentation would be possible or in drafting or anything would be right for the audit, PCS as an auditor.
So, madam, what should be the periodicity of the audit? It should be quarterly, half-yearly, yearly. What will be more beneficial to the company?
Quarterly audit would be always beneficial, because then you can't do certain things on a post-mortem basis. It has to be concurrent quarter to quarter basis. And mostly audit committee in a small companies, they don't look the quarterly. And we have to, as a push to them, to tell them that it's your duty to do and check quarterly. So I think once the quarterly audit may start, it will be comfortable for the company also.
If you do quarterly audit, then early detection of the fraud.
Sorry, your voice is cracking. I can't hear you. Hello?
If quarterly audit can be there, so that early detection of the fraud can be there, and non-minimize. Savitri, madam?
Sorry, not audible.
I am not audible. Yes.
Yeah, can you just repeat your question? You were not very audible, please.
Yeah, periodicity of the audit, it should be quarterly, half-yearly, or yearly. Because in my view,
definitely, yeah.
Because
right, I would definitely suggest quarterly, because there's also a review which is supposed to be done quarterly. Definitely not yearly, and half-yearly would be, you would be then tallying it with the disclosure which is required to be made, so which will make it very, very heavy. So I would say doing it on a quarterly basis, and actually I would basically say that it should be done quarterly after the financial audit is done, in the sense that a limited review is required to be done on a quarterly basis. After the results are announced, get the related party audit done. So it effectively would be, in the 4th month or in the 5th month, middle of 5th month, you're doing the related party audit, so that if there is some course correction, you're in a better position to be suggesting it also. And if you do it half-yearly, then you are going to be, very, very close to the figures being disclosed also, so which will make it very tough to do it from an audit perspective.
So it will be quarterly basis. Normally there is a confusion whether director remuneration and director's fees and loan transactions should be disclosed by a unlisted company or not in their director report. Disclosure of director's remuneration, director fees, and loan transactions.
See, in case of loans to directors is completely prohibited. So there is no question of having this, because it is then one which will lead to a CARO qualification also. So talking of directors' remuneration and directors' fees, in case of listed entities, this forms part of the CG report, and therefore you are required to give this disclosure. Otherwise, what is required is only under 5.2. 5.2, as per the rules, it's only with respect to listed companies. So therefore, unlisted companies, there is no requirement to make this disclosure.
Yeah, madam, one question. What are the key challenges while conducting the audit of related party transactions? The query from the members, madam. What are the key challenges while conducting the audit of RPT?
You're on mute, Amita.
Yeah, as I said, MBP1 is a major thing. You can't rely only on the MBP1, because many of the directors, they don't give, or the promoters, to get all the related parties. and the list from them would be a challenge. Second challenge would be always that, is it under the arm's length or ordinary course of business? Nowhere it has been documented. Even the audit committee minutes also, it is not documented that it is at ordinary. I mean, in a small company, definitely I have not seen that it has been mandated. So that's a second challenge. The third challenge, which I think is mostly with respect to the material modification. Now, material modification has to be defined by the audit committee. On what basis they will define it as a transaction to transaction? That would be a challenge for material modification for a medium-sized company. That I'm thinking it would be a challenge.
Savitri Madam, would you like to add anything from the voice of corporate? Mute. Madam, you're on mute.
I think Amita has covered it pretty well, and broadly these are the different heads where the challenges would be there. And identification of related parties, as I had also mentioned, is the one which needs to be seen thoroughly. And based on that, one would have to then build on that.
I think register of contract also people are not maintaining properly. That's even the PCS are making some errors in understanding what are to be mentioned in the related party register of contract. If it is arm's length and ordinary course of business, they just don't enter. But 184.2 is applicable. They may have to make the entry of it in the register. That's been missed out many a time, and we draw attention when we go for the audit. That's a common mistake, I believe.
Madam, one more question from the members, that if a board meeting has been conducted virtually, then how the register of contract will be signed by the related party, by the related board members?
I think Savitri Madam would be the right person to give, because there may be number of such meetings and registers. Please go ahead.
Sure. So actually, signing of the register, when it is done physically, when the meeting is conducted physically, it becomes very easy. However, when it is done virtually, one can always take consent of the directors, just as the attendance register, as per the secretarial standards, the attendance register would be initialed by the company secretary concerned. Similarly, in this also, consent could be taken and it could be stated, and subsequently get it signed when you do have a physical meeting. It should be fine. But at the same time, I must also admit that there is no specific guidance with respect to this, but this would be a practical way of addressing that.
Yes. Madam, next question is that with effect from April 1, 2023, RPT of subsidiaries exceeding 10% of its annual stand-alone turnover would require prior approval of the audit committee of the holding company. In case of subsidiary is having nil or say a turnover of 1,000, then in this case a transaction of even ₹100 by the subsidiary with its own RP would require prior approval of the audit committee of the holding company. Is it not illogical, Madam?
I will not comment on the last part of the question, but the understanding is absolutely right. 10% of the standalone will certainly require approval of the audit committee of the listed entity. So, currently it is 10% of the consolidated turnover of the listed entity. When it gets converted into 10% of the standalone of the subsidiary, yes, I agree, it will actually become a very small figure, especially with respect to new entities which have just started business or which are yet to start business. So, you will possibly have a turnover of virtually nothing, and 10% of that would actually mean that you would have a large number of entities, a large number of transactions going to the audit committee of the listed company, which will be very, very, very difficult. And I don't personally see much of a benefit out of this. But having said that, the law the way it is today, yes, that's exactly what it means.
Yes, madam. Next question is, RPT already approved by the shareholders before the November circular for 3 years, not breaching the new threshold limit, requires fresh approval of shareholders? It is the question.
No, it does not require fresh approval, and this has been very clearly clarified also. So it does not require.
Okay, madam. Thank you, madam.
I
Next question.
think, Savitri madam, if you can just clarify for the shareholders omnibus approval, which has been mentioned in the SEBI circular, there is a misunderstanding of people, and that's why this question has come. So if you can, for the benefit of everyone, you can elaborate.
Sure. So actually, yes, there is a bit of a confusion as to what exactly this would mean. But if I were to interpret it, I would say that omnibus approval, which has been taken without specifically detailing the transaction, you possibly can pass with respect to the subsidiaries, and the validity will only be 15 months. It's supposed to be an enabling provision, but it's not really come out exactly this way. But where you take an enabling provision and it is in excess of 1,000 crores, where you're not able to specifically detail all the terms and conditions, and you've generally covered it, then the validity will only be 15 months. There are some companies which have generally covered without specifically referring to the specific terms. So that's possibly what SEBI has meant over here, but this is just my plain interpretation. Probably this is the way it is supposed to be interpreted.
What is the meaning of 15 months from what AGM to AGM? Because normally we take a related party transaction as a financial year. I don't know. This leads to little confusion. 8th April clarification from AGM to AGM.
So what they're basically trying to say is, let's assume in the AGM of 2022, you pass such an enabling resolution for 15 months, then you're actually getting time right up to the next year's AGM, when you once again go back to the shareholders to seek their approval. And therefore, it is an enabling one. And why 15 months? Because the gap between two AGMs is 15 months, and therefore they have said 15 months should be the gap. Because if you just say 12 months, then you may not actually hold your next AGM within 12 months from this year's AGM. And that is the reason they've given this 15 months time period. But 15 can also become 18 with the permission of registrar. But anyways,
that's not been covered in the SEBI. Yeah, but at the same time, what is the understanding between the 1st April 2022 to 30th September 2022, the 6 months, which is now, and there could be an excess of that material threshold. What does it mean? SEBI could have given only for one financial year, this provision has been given, and next financial year, it should be from financial year to financial year, rather than giving a general such kind of permission for 15 months from AGM to AGM.
That's of course true, in the sense that, so actually a related party, the approval is generally given for a financial year, as you rightly said. So what happens if in the next financial year, before you go back to the shareholders, it is exceeded? Okay. Here I would say that before you go back to the shareholders, if it gets exceeded, in any case, when you say it's going to be for 15 months, you are required to look at the material related party transaction based on financial year basis only. So therefore, although you may be taking it, let's say in September 2022, whatever happens between September 22 and March 23, in any case goes under one financial year and will be excluded. So April to next September is what you're going to be considering. And April to September, if the threshold is not breached, you are still good. So it again depends on how exactly you've covered your approval.
So that means we have to read in conjunction with that 1st April 2022 to 30th September 22, they have given a liberty, because it can be the first general meeting after this 1st April. So that part is covered. And then you can hear that we have to read in line with both the, Thank you, Sandeep ji. Please go ahead.
Next question is, what if all the shareholders of a public limited company are interested?
So this is exactly what I covered a little while ago when I mentioned about high value debt listed entity. So, you would not have majority of minority, but at the same time, 0 on 0 is 100. It will only require disclosure.
Because beyond that, there is no other possibility. I believe that
there is
central government is not going to approve. So the shareholder is the ultimate, and for their interest, they would be the right people. If you see the intent of the law.
Correct.
Yeah. Yeah, our next question is, madam, how to ensure that a transaction is at arm's length price or a ordinary course of business? Suppose there is a question, madam, that company A has given corporate guarantee to company B and charge guarantee commission, but this type of transaction is only one in a financial year. Company A is telling that it's a ordinary course of business because it is his business. But how it can be proved that whether it is ordinary course of business or not?
I think
See, whether it is in the ordinary course of business or not is one which is, I would say, based on facts. In the sense that if an entity is doing business, ordinarily would it have done something like this? And if the answer is yes, say for example, if you have given a guarantee with respect to one of your subsidiaries, there is no problem at all. But if it is not a subsidiary, it is completely an unrelated person in the sense that it's an associate or yeah. Then you would and this is the only guarantee given by the company. Then there is an element of doubt as to what is the benefit that you're getting. Let's assume it is an unrelated party in the sense that it is related as per accounting standards, but otherwise, completely an arm's length, and you've given it because there is a business benefit that you're supposed to be getting. Then it will be considered to be an ordinary course. So what is the benefit to the entity, which will also have to be seen, and it has to be a commercial benefit because entities are in business.
if for business, if it is, I think Sandeepji, I will add here one more thing. For the ordinary course of business, anything what Madam said is correct, but it cannot be through the omnibus. Many times people are considering this as an omnibus. It is not an omnibus transaction. It is once in a, it's not a repetitive in nature to give such kind of a loan or guarantee. Yeah, thanks.
Achha, madam, is it mandatory that business in the course of ordinary course must have been mentioned in the main object of the memorandum?
Not necessary. Not necessary. It may be there, it may not be there. And just because it is in the main objects does not mean it becomes ordinary course. It is a matter of facts.
I think ordinary course of business is not understood in PCS fraternity, and there are a number of debates in companies at 2013 when it came. Ordinary course of business is not mandatory, but is to be mentioned in the main or memorandum or the main object. It could be anything without which you cannot do the business. It is a part of your activity of business. That could be in the ordinary course of business.
Yeah, our next question is that, madam, explain our nearly 5,000 to 6,000 participants are there in this webinar, madam. So we are getting a lot of questions from there. So our next question is, in terms of regulations 23(9), SEBI LODR companies are filing RPT transaction for half year ended 31st March 22. Our companies are also required to file disclosure in format as prescribed under Part C of SEBI Circular dated 22 November 21. Should I repeat once again?
Sorry, if they are filing as per 23(9), the format now is as per 22nd November 21 only. So what are they filing and how are they filing?
Okay, madam. Yeah, next question is, madam.
Amita, any clarification that you, am I reading the question right, Amita?
Yeah, I think so. Can you repeat? But I believe that an exert H, it is a new 22nd November, whatever the format is given, it is in that format you have to submit, correct?
Correct, absolutely.
Yeah, your answer is, I think question was that only.
Yeah, next question to Amita Desai. As per section 188 of the Companies Act 2013, if transaction is in ordinary course and arm's length basis, even then there is a necessity for AOC2.
Sorry, is it necessary for?
Filing AOC2.
AOC2?
Yeah.
Oh, no, AOC2 you require only as per it. Normally, I have seen people just copy whatever is disclosed in the accounting standard and the balance sheet. AOC2 doesn't describe that. AOC2 says what is the material, then you have to describe. And 198 is a separate. It is for your approval for an unlisted company. It doesn't require the related party transaction. It is not a related party transaction. So it doesn't require.
Yes, ma'am. Next question is, can company avail the loan from LLP in which the director is a partner?
Can company
See, just 1 minute. I would just like to add to this point. If the transaction is in the ordinary course of business and on an arm's length basis, it does not require disclosure in AOC 2. And 134 is also very clear about it, because 134 very clearly refers to 188.1. And 188.1 very clearly is stated. I mean, while 188.1 only gives the listing of the transactions, the section will not be applicable if it is in the ordinary course of business and on arm's length basis. In which case, if it is not one which requires board's approval, the disclosure will not be required at all in AOC 2.
No, the question, madam, was about the remuneration to the managing director. 198, he said. No, what do you say? 197, 198?
No, that is subsequent. I'm referring to the first one of AOC 2.
AOC.
Yeah. Okay. Yes, please go on. Yeah, your question was on managing director remuneration. Yeah.
Yeah. Next question is, can company avail the loan from LLP in which the director is a partner? Can company avail the loan from LLP in which the director is a partner?
There is absolutely no bar, because the company is the recipient. What 185 says is not to give loan. So therefore, it is the reverse over here. You're taking money, but what is important is you need to see whether the terms, this will be a transaction with a related party, and it will not be a related party transaction as is referred to in section 188. But since it's a transaction with a related party, 177.44 will get attracted, and the audit committee will need to see whether it is in the ordinary course on an arm's length basis, which is if the interest rate which is being paid to this particular LLP, is it comparable to the interest which is paid to other entities and other parties? Otherwise, this person should not be getting more than what others are getting by way of interest.
No, we are availing the deposit. I mean, we are availing the loan. So we have to check the deposit rules also.
If it's an LLP, yes, you will need to see, but LLP is a body corporate, and it may be, in which case it will not be an exempted deposit. It is not a company. It is not a company to company. However, it may be a deposit with respect to a transaction, in which case, it would be exempted. However, you will need to see the conditions, terms and conditions, and see whether it is okay to be receiving this or not.
So there are two angles, related party plus deposits both. Yeah. We are here for related party, then madam says is correct, but I believe there is a deposit. If it's taking loan, then you have to check the deposit part also. Yeah.
Yes, of course. Yes. See, if there is an underlying transaction entitling it to an exemption under the deposit rules, fine. If there is no underlying transaction and it is purely as money which the company requires, then you will clearly fall under deposits. Assuming for a second the company has filed necessary disclosures with respect to acceptance of deposits as is given in 2073, in which case the company will not be prohibited from accepting. Let's assume all those compliances are taken care of, even then being a related party, transaction, whether it is an arm's length or not, will also need to be satisfied.
Yeah, madam. Next question is from the participant. Is HUF a relative? If yes, in which section it is covered?
The section 76 only, and read with the rules. The rule on the specification of definition it covers. Am I right?
Section 2, subsection 77. No, section 2, subsection 77 of the company.
Read with the rules of specification and definition. Yeah, it's covered.
Yeah. Yeah. Next question, madam. If X Limited is a promoter of Y Limited, then of Y Limited, any transaction with X Limited, it will be RPT as per SEBI LODR. Should I repeat once again? If X Limited is a promoter of Y Limited, if X Limited is a promoter of Y Limited, then for Y Limited, any transaction with X Limited, it will be RPT. Question mark.
So X Limited is a promoter of Y Limited.
Limited. Then for Y Limited, for the company Y
Yeah.
Limited, any transaction with X Limited will be RPT.
Yes, of course.
Yes, it's a promoter group. Yeah.
And the next connected question, but for X Limited also, whether the transaction is RPT.
So X is a promoter of Y Limited.
Yes.
And what is the holding? Is it an associate company? Is it a subsidiary? Let's assume the holding is, yeah.
Not mentioned in the question, madam.
Yeah, so let's leave it, because let them tell us as to what the holding is. Because just because you're a promoter, let's say you're a promoter with 2% holding, okay? Then for X Limited, is this a transaction with a related party? Since the company is a promoter and the holding is less, it is not a subsidiary or an associate, it will not fall under this. And let's assume none of the directors are also directors there holding any shares. It will not be a related party. But again, what is important is whether Y Limited is an associate or is a subsidiary will need to be seen.
Yes, madam.
And if the directors are also common.
Yeah.
Yes, madam. Next question Next question. Can a public charitable trust formed by the company for its CSR activities? Can a public charitable trust formed by the company for its CSR activities, having two of its promoters as trustee, be deemed as related party?
So actually, a trust is not a body corporate. A trust may be a society and registered under the Trust Act also in India, in Bombay, sorry. In several other states, it is not even required to be registered. Now, the trustees, there is no provision which very clearly states that trustees are related parties. But let me go to the object of the trust. Object of the trust in this case is charity. It's a charitable trust. If it's a charitable trust, under the Ind AS, charity which is done or donation which is given is not a transaction. A transaction has to be a commercial transaction. So therefore, whether it will be a transaction at all or not is something which requires consideration. In my opinion, it will not be considered as an entity in which the directors are interested. Now, the promoters are the trustees, okay? And will this require disclosure under 23(9), transaction with a related party? Now, is this to be considered as a related party? I would say, to be conservative, one can show it as a related party. Going strictly by law, it does not fall.
And what if it is a corpus fund?
So corpus, the entity is a trust. Corpus is only the accounting as to what you have given the money for. And going by the CSR rules, you cannot give it as a corpus fund. But
No,
there is
I'm not
which
considering.
prohibits you.
Company is not considering as a CSR fund, but simply company has given corpus fund. Then in that case, whether it will be considered a transaction, because it is not for the charity.
No, it is not a transaction. No, so it is actually not a transaction at all, because the money has been given for charity.
No,
let's assume,
corpus fund. Sorry, please go ahead. Yeah.
So Section 181 permits the company to give contribution for charitable purposes. So you have given some money, and 181 is not CSR, so there is no prohibition with respect to corpus, nothing. And you have given this money as charity. Now, is it a transaction? As per accounting standards, it is not a transaction. As per transaction with a related party, is this a related party under Section 2, subsection 76? Answer is no. There is nothing which very clearly covers trust. So therefore, from a legal perspective, technically, it does not fall under this at all. However, from a interest of directors, when you pass this resolution, you would show them as interested because they are trustees. Because when you look at the definition, it says financial or otherwise. Okay, so therefore you would be considering it. Somebody has written LODR says transfer of money. Of course, LODR says transfer of money, but to a related party. Is this a related party at all? And where is it a related party? From a technical perspective, it is not a related party. However, from a disclosure perspective, show it. It's better to comply.
No approval is required, but disclosure is required.
Approval is required under 181 if it's a charitable purpose. So in any case, you won't require.
Assuming there is a listed company and 5-6 listed company, or maybe the group companies are coming together forming a Section 8 company, and for the CSR purpose, directors and nominee, independent directors are also common. Those kind of transaction also is not covered under the, because it's a charitable, for the purpose of charity. So the transaction itself, even the subscription money which goes, it's not for the goods. And so it's not a transaction because you are just subscribing to the memorandum.
Absolutely. So the point here is, what is a transaction? And the term transaction needs to have a commercial angle to it.
Yes, madam. Madam, our next question is, what are the sufficient or appropriate audit evidence to be obtained by the RPT auditor to identify whether any RPT have been appropriately accounted for and disclosed?
Very Madam, challenging. To whom this question is?
To you, to APCS.
Okay. So I think this appropriate, adequate, absolute, I have put in my PPT also. These words are, we can't play with this word, but we have to see whatever documents we have are complete and fair, and it has been reviewed. So the supporting document, when we do audit, we should obtain and ensure that these are adequately covering what they mean. And with respect to the arm's length ordinary course of business, when there is no another quotation or any comparative is taken, then we have to meet management, understand what is the justification. And now the audit committee, if it is a listed company, the justification onus is on the audit committee to approve. So we have to go with that. But supporting document should be maintained for at least 8 years and have your working papers to safeguard your back. Tomorrow it may happen that PCS will be questioned that nobody has raised the alarm, or you can't ignore certain whistleblower complaints also. That is also very important aspect to for the auditor to look at it. You can't ignore. You should at least review whistleblower complaints also. Savitri, madam, you have some experience on the whistleblower?
I think there have been few which have come up in the past on these matters. This has led to a lot of discussion. Owing to paucity of time, I think I would prefer not to discuss this in elaborate manner.
Sure.
But we are, madam, very happy that you mentioned that practicing company secretary can be the best professional for RPT audit. So we are happy to hear it, madam.
I truly believe.
And madam, we are approximately 5,000 to 6,000 participants hearing. So we are having a lot of questions, but due to shortage of time, due to time limitation, we have to close the program, madam. And my heartfelt thanks to both of you, madam, both Mr. Desai, madam, and Savitri Parekh, madam, that you spare your valued time for ICSI. And madam, both of you have shared your whole idea in a very transparent manner so that it can be understood by our members in very easy way. My heartfelt thanks to ICSI team also. My heartfelt thanks to all the participants who have joined this webinar and have benefited from the words of Savitri Parekh, madam, a guru of Companies Act, and then Madam Amita Desai, one of the best practicing company secretary in Mumbai. So now I would like to request our ICSI team to please display the Sahit Tibeti certificate to Madam Savitri Parekh. ICSI ICSI team to please display the Shahid Ki Beti certificate to Savitri Parikh madam. Savitri Parikh madam, this Shahid Ki Beti certificate is for you, madam, and the hard copy will be sent to you at your office address, madam.
Sure.
And now please display the Shahid Ki Beti certificate to Madam Amita Desai.
Thank you.
Madam Amita Desai, this is a soft copy and hard copy will be sent to your office in
Sure,
short
thanks.
ICSI team, please display the certificate of Shahid Ki Beti to Madam Amita Desai. Yes, madam. This one.
Thank you.
So, madam, thank you very much once again. Thank you to both of you to spare your time, madam. And thanks to ICSI time. Thank you, madam.
You can collate all the questions, Sandeepji, and circulate for our knowledge and study also.
Yes, madam. You will.
Thank you.
Thank you very much. It's been a pleasure.
Madam Desai, can we have your presentation, please? Because some of the participants want it.
Yeah,
Can we have your?
I have sent to share with Alka ji, I believe.
Okay,
Alka ji
madam.
has. Yeah.
Okay.
Okay.
Thank you, madam. Thank you very much.